Ever wondered how to navigate the intricate web of compliance processes while maintaining top-tier security for your notarial records? The solution is closer than you think. Introducing Comply Chain Guard, or CGG, a platform designed specifically for civil law notaries. CCG merges the complex chain of compliance processes with unrivaled protective measures. It enables you to stride confidently through the multifaceted terrain of regulations while ensuring paramount security for your records, deeds, and transactions. CCG boasts a regulatory compliance engine that keeps you updated with real-time insights tailored to civil law regulations. It effortlessly integrates with legal databases and ensures automated compliance checks for all notarial deeds and transactions. But that's not all. CCG also features advanced encryption to safeguard your notarial records. You'll benefit from multi-factor authentication and periodic security assessments, upholding the sanctity of every notarial act. Plus, with continuous transaction monitoring, you'll receive alerts for any discrepancies and comprehensive logs for traceability. And when it comes to reporting and analytics, CCG generates automated compliance reports specific to notarial acts. Dive into our analytics dashboard for transaction patterns and predictive insights. Why choose CCG? It brings efficiency, security, and compliance to your fingertips, allowing you to operate with unmatched confidence and credibility. CCG integrates effortlessly with your notarial record-keeping systems. Our API facilitates bespoke integrations, ensuring compatibility with major legal platforms and databases. And remember, our dedicated support is here to assist you every step of the way. CGG is the future of notarial practices. It redefines your work, ensuring accuracy, credibility, and peace of mind. It's a transformative experience tailored for civil law notaries. Don't wait. Contact Comply Chain Guard for a demo or more information. Step into the future of notarial practices. Your journey to seamless compliance and robust security starts with CCG.
The alternative lending industry can provide a very lucrative opportunity for brokers and affiliate partners. Whether you're specialized in commercial lending or real estate financing, having the right funding partner can make the difference between earning thousands on a deal or losing a commission. Go Capital understands this. You work hard to secure your clients and deserve to be compensated. Unfortunately, due to increased competition, many lending companies have stopped working with new agents, are not providing adequate training, are slow to respond, and simply not issuing competitive approvals. By joining Go Capital's partner program, your dedicated support specialist will assist you every step of the way. As a broker, you know that it's not always a matter of obtaining a loan approval. You need competitive terms. Go Capital's catalog of loan products allows you to offer the best financial solutions to your clients. Options include business lines of credit, SBA loans, merchant cash advances, commercial mortgages, hard money fix and flip loans, bridge financing, equipment leasing, invoice factoring, and more. What does this mean for you? More deals, more commission, and satisfied customers. As a registered partner, you'll receive free access to the Broker Affiliate Sales Portal. This system allows you to easily manage your deals and also offers tools, training, and resources that will help you succeed. Frustrated with never being able to speak with someone about your deals? At Go Capital, someone is always available. Whether you prefer to call, email, chat, or even visit our office headquarters in downtown Miami, we are always available to answer your questions. While other companies may advertise the highest commissions, they often fall short when it comes to issuing competitive terms, making the process easy, or simply being responsive. Go Capital provides quality broker support and training, and quickly identifies how to best structure a transaction. With our multitude of loan programs, comprehensive training systems, and quality service, you can focus on more important things, generating more business. Need us to join a conference call with a client? Need help presenting an offer? No problem. Our loan specialists are here to help. For more information or to sign up, visit our partner page on www.gocapital.com today or call 1-866-257-2973 and speak with an account manager. Go Capital, where your success is our business.
North Avenue Capital started with a vision of being the best lender in the industry. for us to be effective, we needed to understand rural communities and the businesses that are critical for keeping those local economies thriving. North Avenue Capital provides financing in partnership with the USDA Rural Development Program. The main purpose of the USDA Rural Development Loan Guarantee Program is to encourage lenders to deploy capital into rural communities with the underlying objective of creating jobs, spurring on economic development, and helping establish and build businesses in communities outside of large metropolitan areas.
The USDA Business and Industry Loan Program is a secured asset lending program. We refinance existing debt, we do ground-up construction, we provide capital to improve real estate and provide working capital to borrowers across the country. The benefits of the USDA B&I program are the rates tend to be very competitive. They're very long-term loans, up to 30-year term and amortization. It tends to be a highly levered product, so oftentimes we can get up to 75% loan to cost on startups, and on the right existing business, we often do 100% financing. The types of deals that can be done in the USDA B&I program are all forms of commercial real estate, office, industrial, retail, hospitality, but then also specialized sectors, vineyards, wedding venues, nurseries, family entertainment centers, even oil and gas and mining.
In order for a borrower to qualify for a B&I loan, first of all, they have to be a for-profit business or a startup business, but they need to be located in a rural community outside of a big city, which actually comprises 97% of the country. In fact, many borrowers are operating in rural communities and may not even know it because of their proximity to a suburban or metropolitan area.
If you have an opportunity that you think may be a fit for one of the USDA loan programs, you can find us at northavenue.com, and we're all over the internet. We look forward to working with you.
Understanding syntactical trust training and insurance documentation. Summary. The video presentation discusses tactical trust training and the role of automated underwriting software in securitization audits. The focus is on the DTCC Replacement Implementation Guide linked to Accord Life and Annuity Standards, revealing its correlation with global insurance standards. Various insurance forms and their functions are explained, including property loss notices, liability notices, and certificates of insurance. The video also touches on specialized forms for different types of insurance and the use of forms in arbitration processes. The presentation emphasizes upcoming in-depth training on syntactical trust banking and M3 conveyances. Highlights. First, the video introduces tactical trust training and the use of automated underwriting software for securitization audits. Second, the DTCC Replacement Implementation Guide is tied to global insurance standards and correlates with Accord Life and Annuity Standards. Third, various insurance forms such as property loss notices and liability notices are discussed, along with their roles. Fourth, specific forms for different types of insurance like trucking and commercial property insurance are highlighted. Fifth, forms play a crucial role in arbitration processes, populating based on requests and activities. Sixth, the presentation mentions specialized forms like those for professional liability, money transmittal bonds, and key man insurance. Seventh, Forms 831 and 833 are emphasized for reporting claims involving lawyers and other professionals. Eighth, the importance of gathering materials for upcoming in-depth training on syntactical trust banking and M3 conveyances is highlighted. Understanding syntactical trust training and insurance documentation. In the realm of financial operations, syntactical trust training plays a vital role in ensuring compliance and effective implementation of automated underwriting software. This comprehensive guide sheds light on the intricate world of insurance documentation, aiming to equip compliance officers and insurance professionals with the knowledge necessary for accurate and informed decision-making. From the correlation between global insurance standards and automated underwriting to the utilization of specific forms in various insurance scenarios, this article dives deep into the core of syntactical trust training. The role of automated underwriting software in securitization audits. Automated underwriting software is a key player in the world of securitization audits. These audits are essential for evaluating the compliance and security aspects of financial transactions. By utilizing automated underwriting software, organizations can streamline the auditing process and ensure accurate assessments of various financial instruments. Understanding the DTCC Replacement Implementation Guide. At the heart of insurance operations lies the DTCC, Depository Trust and Clearing Corporation Replacement Implementation Guide. This guide, rooted in Accord life and annuity standards, serves as a crucial reference for compliance officers and insurance professionals. It establishes a direct link between the DTCC and the core, which deals with global insurance standards. This connection is particularly relevant for those involved in commercial insurances, such as tractor-trailer insurance, where certificates of insurance originate from the core. Decoding the Accord Form Index. The Accord Form Index is a treasure trove of forms used in the insurance industry. From property loss notices to liability notices, this index encompasses a wide array of forms catered to diverse insurance scenarios. For instance, individuals making claims on insurances will encounter forms such as Notice of Occurrence and Claim, Property Loss Notices, and more. Property Loss Notices. Notice of Occurrence and Claim. Intermodal Interchange Certificate of Insurance. Certificate of Property Insurance. Certificate of Liability Insurance. Evidence of Property Insurance. Evidence of Commercial Property Insurance. Statement of No Loss. Financial Responsibility Form. Insurance Binders. Commercial Insurance Application, Form 125. Accounts Receivable for Valuable Papers. Professional Liability Supplement, Form 187. Money Transmittal Bond, Shared Report of Execution, Form 501. Contract Bond Request, Forms 502, 503, 504. Professional Special Insurance Application, Form 825. Lawyer's Professional Liability Section, Forms 831, 833. Navigating the complexity of insurance documentation. The intricate web of insurance documentation comes to life through various forms that serve distinct purposes. From professional liability supplements to notices of incident or claim, these forms cater to professionals, specialists, and various insurance scenarios. For instance, Form 831 and 833 for lawyers and other professionals. Form 825, Professional Special Insurance Application. Form 501, Shared Report of Execution for Money Transmittal Bond. Forms 502, 503, 504, Contract Bond Requests. Property Loss Notices and Notice of Occurrence and Claim, the Reinsurance Connection. Applying Syntactical Trust Training in Practical Scenarios. As professionals navigate the world of insurance, syntactical trust training becomes crucial for accurate implementation. From understanding specific forms to using them effectively in various arbitration scenarios, this training ensures compliance and informed decision-making. For instance, Schedule C on Admiralty Claim and Notice of Fault Demand for Payment. Cross-referencing forms for effective reinsurance. Embracing the future of insurance operations. As the industry evolves, syntactical trust training remains an essential cornerstone of insurance operations. This guide serves as a roadmap for compliance officers, insurance professionals, and all stakeholders involved in the intricate world of insurance documentation. By grasping the nuances of syntactical trust training, professionals can navigate the complexities of the insurance landscape with confidence, ensuring compliance and effective decision-making. In conclusion, syntactical trust training and a deep understanding of insurance documentation pave the way for efficient operations and informed choices in the insurance industry. This guide serves as a comprehensive resource for those seeking clarity and proficiency in navigating the intricacies of insurance forms and procedures. As professionals continue to engage with the evolving landscape of insurance, syntactical trust training remains a valuable asset that empowers them to make impactful decisions and contribute to the industry's growth.
Welcome to the podcast, Dan.
Thanks, Peter. Great to be here. Thanks for having me.
My pleasure. Okay, so let's get started by giving the listeners a little bit of background about yourself. Why don't you just tell us a little bit about what you've done and what you do today at Garnett?
Sure. So I'm Dan Arlotta. I'm Senior Vice President at Garnett Capital. Often tell people, look at us as Garnet no capital. We don't buy anything, although, sometimes it's a good way to get somebody to appear for a meeting. We're a loan sale advisor celebrating 20 years now and involved in the sale of performing, non-performing, and charged off assets across really all product types. Roughly 30 people headquartered in Westchester County, New York, with offices around the country from Tahoe to Minneapolis, Boston, Atlanta, and Houston. Despite I would say have really no other axe to grind other than maximizing price, terms, mitigating risk, protecting brand reputation for the sellers we work with, while putting together a deal and story in a transparent, fair process that allows buyers to easily digest and trust what they're buying. We work with some of the largest banks, credit unions, government agencies, and obviously fintechs in creating and building markets for product that doesn't trade every day. Nobody's hiring us to sell Fannie Mae eligible mortgages. We're the ones that are doing horse trailer loans, RV marine, student loans, personal loans, auto, again, a lot in the fintech space, but a wide array of products where you really need to come up with the story, understand the product, find the right people, and get the deals done. I'm a part of the sales team here, covering banks, credit unions, specialty finance, debt buyers. You really have to be a generalist first, although much of the work that I do here involves honing in on the fintech space. Been here 11 years now, which often joke feels like yesterday and 50 years at the same time. My first sales job, I always say, was selling pens and pencils that I was collecting from my parents' house in first grade. Great business, by the way, 100% profit margins, but short-lived. Fast forward a little bit more, prior through a series of internships, was heading toward more of a fixed income sales and trading path until the company that was hiring me out of college went under halfway through my final year. So, welcome to finance, right? Big believer, though, in things happen for a reason, and, persistence, good habits, things work out. Garnet gave me a shot, and, here we are. So it's a great place. Get to speak with smart people every day, work on short, medium, long-term projects, but every day is a new day. And that keeps me from getting bored and keeps me excited.
Right. And it has been an interesting last 11 years, to say the least. So before we get into it, maybe let's take a step back. What is the state of loan buying today? Obviously, particularly interested in the fintech space, but maybe you could give us a sense of the overall space as well.
Yeah, sure. So, I think I'll maybe do a little bit of a look back the last couple of years, maybe since 2020. And maybe even before that. I think the fintech space arose, following the Great Recession, a little bit more benign environment, rates, going down or, flat, which was great because it allowed for growth, of the new industry. I think that looking back in 2014 I was sent for kind of a recon mission out to San Francisco at Lend It at your conference. And, it was a more entrepreneurial space than I think where it is today. That's, a little bit more focused on, how the efficiencies should work and, a little more fine-tuned. You look at 2020 and, especially following COVID, call it latter half of the year, things really started to take off, right? Borrower performance was great. at really all ends of the performance spectrum, all the way down to charged off, where people were getting their stimulus checks and making payments on things that they hadn't, frankly, in years. It was a market where if we brought a deal, if you brought it, they would come, right? And saw a lot of deals where if price talk was X to Y, everybody would be at least in X to Y. And then you would have, through some combination of, what I call maybe second place syndrome, or just needing a deal, you had a lot of outliers, right? And that remained, I would say, through the end of certainly 2021, a little bit into 22. I think at that point, right, you had inflation starting to pick up. Subsequent rate rises would follow, less on the stimulus packages, and really changed things, I would say, a little bit throughout 2022. You started to see less of the outliers, a little bit softer market conditions, to where I would say the end of 2022 through end of Q1 2023 was probably the biggest shift I've seen in the market since I've been here. I would say, obviously some of it, you had banks having issues last year, that doesn't help. You have cost of capital going up, from the lenders to the lenders to buyers, kind of the entire stack there. You also had rates starting to go up. And, when that happens, it was really the first time since I've been here that seasoned portfolios that already existed, right, were, from a rate perspective, underwater relative to new originations, right? And what does that usually mean? That means discounts. And I would say for most of last year, certainly the first half, maybe through Q3, and again, especially on the performing side, fintech being included in this, you had some real bid-ask spread challenges, right? I think that the market shifted towards more of a buyer's market. Sellers spend some time getting used to that, wanting pricing more of old. But throughout the year, kind of understanding where the market was to where more deals could get done. I think there were a lot of deals, especially in the consumer space last year, floating around. I get the gut feeling that 2 in 10 actually were getting done. So for us, we really had to pick spots, and opportunity cost became much more paramount. I would say as we enter this year and where things stand, there's liquidity in the space, which is great. I think that it's liquidity at what price and relative to what other opportunities may be out there. I remember May of 2016, right? There was a bit of a hiccup in the fintech space, pretty early on in the days there, that had an effect of more tourist investors, right? So we saw between 2016 and 2019, we were pretty busy in selling secondary pools for investors that came in for a year or two, moved out, called it a day, maybe shifted strategies. But as I see it today, there seems to be less of that. I think that the fintech space is more ingrained in the market, and seems to have more long-term viability than them. So net, I think the investors in the space have grown and are more stable, right? To realize that there's going to be some ebbs and flows. I think a lot of the market is still dealing with, call it the late 21, early 22 vintages. The performance on those haven't been as strong. But again, as it seems like a moment in time, where as that starts to season its way out and curves flatten, new underwriting with higher rates comes through. I think the platforms have been smart about that over the last year and a half, and adapting to where people are committed. On the secondary side, and sort of our space, I would say people are always looking at it as, what can I get on the secondary side, a seasoned pool versus what I'm buying directly from the platform. And there seems to be some more interest, I would say, in the secondary side as of late. I think some of that has to do with you can look at a pool that already exists, likely already have similar vintage product in one's book, and offers an opportunity to, I would say, to shorten one's duration if that's something that somebody's looking to do, and pick up some more product along the way. So net, people have liquidity. We're seeing more deals in the space. It's it seems to be. We saw a wave in between 2016, 2019, a little bit less over the 2019-22 period. And things have sort of been picking up, I would say, latter half of last year into this year, where it feels like, as far as fintech product in the market, call it third or fourth inning sort of feelings around that.
Right. Yeah, that's what I was wondering about, because you talked about 2014 when you went out to our San Francisco event, and then that followed. 2015 was like a go-go year where everyone just got funded. Yeah. Everyone was just, money was just sloshing around all over the place. Whereas now
that was 2021.
Yeah, same
again,
as right, exactly.
So yeah.
Revisited, but then now I'm just curious about the state of the market today, and particularly I'm interested in the, because there's now lots of banks. Like back in 2014, 2015, personal loans were pretty much all done in the fintech space for the most part. Now, lots of banks are doing personal loans, and a lot of them are just holding on their balance sheet. They're not doing a whole bunch of sales. But I'm curious about, when you're talking to buyers, is there much of a difference between a fintech pool of loans than a non-fintech, like a traditional financial institution doing a pool?
No, I don't think so. I think you see a lot of 3, 4, 5 year term loans, right, of similar balance. I think the only difference, I would say, banks, credit unions, they're going to focus a little bit more on the higher credit. So you see incremental, maybe higher FICOs as a whole. They're also going to have more stringent floors on types of credit that they will originate to. But you're right. I mean, for the most part, those originations in the non-fintech community have largely been just held on balance sheet. I think that there's a reason, though, why the fintechs exist and still exist. That banks on the commercial side, right, doing a $100,000 loan or a $5 million loan is kind of the same effort. And when you're looking at more volume maybe versus the balances, it's still something that I think is tougher for them compared to the fintechs. So I remember back 2014, 15, right? I mean, there's panels on banks and fintechs, partner or build oneself. Also things like cost of borrower acquisition, right? I mean, that's the advantage that a lot of banks have, that they can tap into their existing base versus actually acquiring a customer, which can be expensive. Some of those same things still, and I think same questions still exist out there. With incremental progress along the way.
Right. Okay. So then, like now with interest rates have been high, like they seem to have stabilized, at least for now, with most people thinking the next movement is down. But But are we with that obviously higher borrowing costs, that have been, with people have been used to low interest rates for a long time, and now looking at probably interest rates double what they were, when you're doing say a personal loan, for example, from 2.5 years ago. Are we seeing an increase in activity in the non-performing loans? What are you seeing out there?
Yeah, and I mean, you're right. There's some of the same deals, selling today that were 6 to 8%, or 12 to 14% now, right?
Mm-hmm.
So it's a real shift. On the NPL side, definitely seeing an uptick in that. I think some of it is related to growth along the way, although it'll be interesting to see the next 6 months or so of what kind of comes from, call it the 2023 type origination product. I think, what we're seeing a lot of now is, an uptick related still to that late 21, 22, which was just before, right? I think inflation and the rate rises kick in. You also had last year, right? I think two unknowns in the market. You had rate rise after rate rise and, not really an end in sight. I think it's a positive that, one can make an argument, does it go lower? Does it stay where it is for longer? But you could at least form a market, I think, around that now. That's a box that people are now used to. Borrower uncertainty and performance, I think still remains. Although it seems like most people talk to, I don't know if it's a combination of hope as well as, actual prediction, but it seems like they're looking towards Q1, Q2 this year of maybe the end of a cycle and some uptick in NPLs. We're definitely seeing more though, and feels like that'll continue at least for the first half of the year. And then, we'll sort of see what the newer underwriting of 2023 at higher rates coupled with, what the Fed does, after that.
Well, plus a lot of the fintech lenders that I've been speaking to, a lot of them decreased their origination volume, and we've seen it with the public companies as well. But even the private ones decreased originations, tightened the credit box, made a much more, skewed it to a much more credit-worthy borrower. How's that sort of
absolutely
going to skew kind of what's in the market when it comes to secondary loan transactions?
Well, like I was saying, right? I mean, if rates do go down, all of a sudden, some of these originations the last 12 to 18 months, right, then become very, very attractive as it goes the other way.
Right.
I think that really throughout 2023, the platforms did took a lot of time and focus on, not necessarily focused on growth, right, which is inherently sort of embedded in being a tech company. But focusing on, sort of maximizing efficiency and, getting it right, which I think they've done a great job on. And, there's always a lag in our business of when you start to see the effects of that. But I have a feeling that, in the coming months and throughout the year, that's going to be show itself in a very positive way.
Mm-hmm, mm-hmm. Okay. So then when you're doing these secondary transactions, who are the typical buyers here? I mean, are we talking primarily hedge funds? I mean, who are you actually working with?
Yeah, so the buyers of the product, and I'll do a little bit of separating, I think, between commercial and consumer. Consumer first, though, most of the time, right? It's somebody that already is buying from the underlying platform's product, right? That we're selling. That makes it a little bit more commoditized. I think that your yield hurdles can be, a bit lower compared to just the totally new product, totally new platform type secondary sale. For the most part, though, it's fintech focused funds, and that ranges from small to large, as well as your mid to large multi-strat credit funds. It depends on the deal size, right? Not everybody's going to look at a $2.5 million pool. Trying to come up with some new ideas and ways to right now to make sure that we have full market participation, and not have various people not be able to show. Sometimes you'll get some banks involved as well. Less so on the, say, credit union side, really because of credit unions needing to memberize borrowers. But for the most part, I kind of look at it as across all the platforms in the consumer space. I look at it as a group of about 50 potential buyers. That's one of the nice things here at Garnet that I think is unique. I get to talk to lenders, the originating platforms, the buyers across all of them. So, you can really listen to all of them and find out where the successes are, where the challenges are. And every time we take a deal out, thinking about what's the optimal way to do this. But, figure funds, fintech focused and not, a little bit on the bank side, less so on the credit union side when we're doing the secondaries.
Right. Okay. So can you share on the platform side or the lender side, can you name some names, like who you're working with today?
Sure. So more broadly, Garnet's been around 20 plus years, right? We've worked with, I would say, most of your top 25 banks. Think Capital One, TD, Key. On the credit union side, we've worked with Navy Federal. On the fintech side, really the first sale that kicked this all off, with Garnet in the fintech space, and in a lot of ways my career was 2017 Lending Club, which was the wind down of LCA.
LC Advisors.
And correct, yeah. And that offers up, obviously, when you have a bigger deal like that, offers up the opportunity to create some domino effects and go from there. So what I'll say is, we've worked with, on the consumer side, the likes of Lending Club. We've worked with Avant. We've sold product of Prosper, Upstart, Upgrade, Marlette. So think some of the larger ones there. I've also done some smaller sales for smaller lenders, especially those looking to get warehouse facilities and kind of get going. But hopefully that gives a little bit of a flavor. I know you had mentioned you saw we had worked with Figure. There's a lot of different product types out there. You try to start with some of the larger ones, create that domino effect. I think since 2017, we've done 40 transactions in the fintech space, roughly $2 billion of purchase price there. And some of that has also found its way into charge-off forward flow sales, which is another one that more and more are looking to sell than work it themselves.
Yep. So I do want to dig into Figure a little bit, because I think it's an interesting case, and I saw, I think you even had a quote in one of the press releases that I read, where because Figure's different to all the others insofar as they have originated everything on the blockchain, on the Provenance blockchain. That how, like, I'm curious about a secondary loan transaction. The process obviously was different, but how, like, I'm curious about the buyer side of this and how they felt with doing something that was so different from what they used to.
Yeah, so that one's actually was more on the new origination side. So, bringing forward flow buyers to the
Okay.
platform was sort of the idea there. Which, I think when people hire us for that type of effort, they're looking less for us to, bring in the hedge fund community and, more of your bank and credit union
Right.
community. So, that's what we were doing there. Um, when I first saw the platform there, I remember walking out of the demo saying, wow, this is really cool. I see the
Mm-hmm.
tech right
Mm-hmm.
here. And, sometimes people are like, oh, where's the tech in the fintech, right? And, they had something very, very unique there. And, that's part of that sort of opportunity cost that we go through, right? We want to go out there with something that's unique and is going to get people excited. They were doing something that most do in, 45 to 60 days, in, no less, no more than 5 business days. Doing it a different way, but, getting there. And, those are the types of things that are always the most exciting about the fintech space where, I think it resonates. Oh, I got a mortgage refi or, a HELOC and, it was painful, it was difficult. And, that I think is ultimately, the fintech space, right, is taking things that already exist, making them far better, far more efficient, far quicker, as well as, just the completely new idea there. So it was a little bit different product or process in that it was, again, more of that new origination buyer. And then, depending on who it is, you end up spending more time on, kind of memberization of borrowers and things like that than the economics sometimes. But
Right. Right. Okay. Okay. So, what if that if you want to, I'm curious. Let me start back up. We can.
mhm.
I'm going to have the editor remove the last 10 seconds. So when you're, say you're a lender and you want to position yourself for a successful secondary transaction. So what are some of the best practices that you would recommend lenders do in order to get the best price they can possibly get on these transactions?
Yeah, so I think, data is paramount, right? I think that fintechs, they've done things certain ways. A lot of times it's their first sale, right? So, it might think that, hey, here's the data file, just have people take a look. This is what we do. I think performance history, data, transparency, being upfront with what the goals are, and really just focus on kind of no surprises in general. I mean, that's the best way to start a process. We like to spend a lot of time upfront making sure that what we think the market will bear, a process in mind, seems to be aligned with the client's goals. So we try to do that at the beginning so there's no surprises. And once you hit the button of going to market, you have the right buyers, prospective bidders corralled. Again, there's no issues. People could put their best foot forward. I look at it as, a part of buyers' jobs are to find the deals that I don't find, right? Those are the deals they want to get in there, be the one in the room, get the home run, grand slam type deal. For us, on one hand, we're looking to maximize price terms for the seller. That's who we're working for. On the flip side, putting together a deal that has as much information in it. The analysts here do a great job finding, the golden nuggets and really telling a story. Because people can do the math, right? But at some point too, you're going to have a finger in the air, especially as you get further down in sort of that performance spectrum, NPL charge off, to really, have somebody get excited and make that jump, right, for a deal. So data, transparency, upfront goals, those are probably the most important things.
Right. Okay, so last question then. I'm curious, we are recording this late February. What's your outlook for the next 10 months? What do you think is going to be the state of the market for the rest of the year?
Sure. So going back a little bit to what, said earlier, I think there's a moment in time thing going on here right now, right? If you look at the investors in this space and, maybe more of that fund community, more so than the bank that's, just handling their own balance sheet. I think if you look back over the last 12 months, right, if you're an investor within a fund, right, you might say if you just compare what the last 12 months have produced to exactly today's relative value, it may not be overly, exciting. However, that I believe is going to, over the next 6 months, with the higher rates, the tighter underwriting, that is going to look very different. So, we have been seeing, some sales of, investor redemption, capital inflows a little bit tougher. That already, though, seems to be sorting itself out, and more coming into the space again. I would say I'd expect to see more first-time sellers of charge-off product. I think on both consumer and commercial, maybe more so on commercial, which really hasn't been much in the way of secondary transactions on either the performing or non-performing side. And yet every article, you can turn up, commercial and cracks forming, all of that. But, there really hasn't been much in the way of supply. So I expect to see more supply on the commercial side. We've done some sales in the space. We did a sale for Funding Circle, about a year and a half ago. And, certain markets, certain niches, especially where, I look at that commercial fintech C&I product. I know one thing I'm out there trying to talk to people about is because there's been such a lack of supply, which is the exact opposite of the consumer space, the buyer community is surprisingly robust, and, pricing still is kind of at all-time highs, especially, again, as you get to that NPL side, where, you have C&I buyers, you actually had CRE secured buyers jumping into the C&I space in a search for product. That still remains. That, to me, is one of the bigger opportunities for holders of fintech commercial to be very surprised at the pricing that they can get out there. And, for a lot of the fintechs, I think, they're running this, sale process or collection process on behalf of underlying investors. And, the money today versus 3 to 5 years could be very attractive there. Otherwise, though, I would say there's ebbs and flows. I actually feel like the more recent challenges, the sale, the wind is shifting in the right direction. There's probably more of a focus on profitability and, as you said, right, scaling back originations, making sure doing things right, than pure growth. And I think that'll continue. I think that there's always these really niche players that start up that are very focused on a singular product where maybe they don't really have much in the way of competition. those are really exciting to me. I think, that's a very specific problem they're trying to solve for. They can get a little bit more, I think pricing power from it. And, the road to profitability is a little bit, quicker and more in sight. I love businesses to like point of sale product where, a lot of times you talk about the cost of borrower acquisition and things like that. They have the benefit of going to merchants and, having them do the marketing for them, right? And, that to me is a space that I think will become more prominent as well. But, I think the deal activity will be busy in the first half of the year. It's an election year, so it could go either way, but could also see how come October, maybe even September, people get into a little bit more of wait and see mode. So I think I know we're focused more on the first half of the year for sure. But in the fintech space in general, I always say the world's not getting less digital, right? Long time ago, I think people wanted to talk to their banker, right, instead of the scary ATM. And I don't know the last time I walked through the next set of glass doors, at the bank. So the world's not getting less digital. Fintech is certainly here to stay. You deal with some ebbs and flows, which is listen, at the end of the day, it's still in early innings in the grand scheme of things. Wouldn't be shocked to see some consolidation as I think equity and debt is more difficult to find and more expensive. So I do think it's a year though where people have the opportunity to kind of separate themselves a little bit more. While also, right, you root for the whole industry because it's new enough, right? You don't want to see anybody falter. So right. I'm optimistic. I'm in this for the long haul too. And at the end of the day, every deal we take out with any fintech, I go to bed at night, really thinking about what's the best solution. How can this sale make a company more successful, more, have with the right partners, and, hope to be a part of that in the future.
Okay, we'll have to leave it there, Dan. Really great to hear your insights today. Thank you so much for coming on the show.
Likewise. Thanks a lot, Peter.
Okay, see ya.
Oh, how the tables have turned. Crypto is back on the menu, boys. That's from what movie? Lord of the Rings. Thank you. Mark Kohler here, CPA attorney, best-selling author, podcaster, influencer on YouTube, helping Main Street America business owners. We've got a law firm, a trust company, a network of accountants and CPAs, enrolled agents around the country. I'm here for you. Crypto taxation. How is your cryptocurrency going to be taxed? Numbers are up. Are you harvesting profits? What's that mean? Are there some tax strategies you might take advantage of? Yes, there are. What are you doing? Are you just trading away in your accounts and your wallets and thinking, oh, all is good? Well, it could come back to bite you. You got to be careful. So I want to talk about some different ways you could save taxes with your cryptocurrency trading or investing or mining or staking, NFTs, all the above. Or we're going to talk about how you even understand. And I want to cover right out of the gate how cryptocurrency and all the related pieces and parts are taxed. So we're going to dive into it now. Excited to be here with you. This is your chance to ask questions. Please put them down in chat. I'm going to cover what I can. We will be having another Crypto Tax Summit. We've done two of them already, one in Phoenix, one in Miami. Now that crypto is back on the menu, things are up, it's exciting. It becomes an issue. And so we're going to be holding at least a virtual crypto tax summit here in the near future, because there's just strategies that are unique to crypto. And if you're going to be trading, you've got to understand what your plan is. Your accountant may not even know some good strategies, or just be picking up the pieces next year when you tell them what happened. So let's get into it. All right, first, number one, the IRS is all over this like white on rice. They just got $80 billion last year from the federal government to enforce more audits, more tracking, more collection for business owners and in cryptocurrency. They've got task force now that understand the blockchain. They can find your transactions. Oh, not on my, DeFi wallet. No, they can. It's on the blockchain. That's what is great about crypto, is it's public. It's on the blockchain. Oh, but the IRS is not that smart. No, they are. They're that smart. So can I just show you the front page of your 1040 tax return? Okay, Jack, bring this up. This is the 1040 for 2023. Okay, see this right here? I don't know. Can I write on this? I might be able to write on this. Let's see. Nope, I can't write. Okay, let's look at here. After your name, filing status, look at the first question right here on your tax return. At any time during 2023, did you receive as a reward or payment for property or services? Or did you sell, exchange, or otherwise dispose of a digital asset or financial interest in a digital asset? See instructions. Okay, did you catch that? If you received an NFT or any crypto via staking, mining, reward, award, payment, anything, or did you sell any crypto? Yes or no? If you check the box no, okay, that's cool. Let's just go down here to, under penalties of perjury, I declare that I have examined this return and accompanying schedules and statements and they are true or correct. Wow. So if you lie on your tax return, it's not pretty, people. Can you drop that now, Jack, please? All right, so the IRS is onto this. You've got to sign your tax return, and if you lie, you could go to jail, all right? Now, some of you are like, holy crap, taxes are due in 4 weeks. My 1040, I don't even know what I did last year on my wallets or in my exchange. Then file an extension. People, an extension is okay. You actually reduce your chances of an audit with an extension. Some of you are like, extension, that's a bad thing. No, it's not. Now you need to estimate how much you might owe, send in a little money. If you don't send in any money, there might be a little penalty or some interest on that. But if you don't file an extension, the penalties are 10 times worse. And if you file your tax return and it's wrong and you lie, then it's real ugly. So first point, if you traded any crypto last year and you think you cannot deal with it on your tax return, you're kidding yourself. I'm here to warn you. Now, you say, well, Mark, all my money's in crypto. I haven't sold anything. I've just been trading crypto. I don't pay tax until it goes back to US dollars. Wrong. Let me tell you the law. There are 3 ways your cryptocurrency is taxed. You buy cryptocurrency for, let's say you bought Bitcoin at 30 grand and now it's worth 72, 73. Your money doubled. You sell it and go back to US dollar. You're going to pay tax. You bought it for 30, you sold it for 70, you have a $40,000 gain. You're going to pay tax on $40,000. And if you only held the crypto less than 12 months, you're paying short-term capital gain, which could be as high as 39%, 37%. These are my brackets right here. You can look at our brackets. We have got to be extra, extra careful that we are not going to hit that 37% bracket. We might want to hold it 12 months and get capital gain, which could be as low as 15% or 0, 15 or 20. So number one, if you bought crypto and you have sold it in 2023 for any gain and you went back to USD, you're paying tax on the difference. Number two, well, Mark, I had Bitcoin and then I traded it for Ethereum. I didn't go back to USD. I just traded it for Ethereum. Taxable. Because whether you go to USD or you go buy a bunch of Ethereum, you got rid of your Bitcoin in that example. I bought it for 30, I sold for 70. I have a $40,000 gain. Well, I just exchanged it for Ethereum. That's the same as selling it. Now, if you don't hate the player, just hate the game. This is the game. You buy stock, you sell it, you pay tax. Well, I bought crypto and I left it in crypto exchanges or wallets. Doesn't matter. If you exchange it, you pay tax on the difference of what you bought it for and the current US dollar value the day you exchange it for another coin. Well, I did it in my MetaMask wallet. Okay, don't care. You're still paying tax. Mark, you have no idea. I do trades every day. Yeah, so you're going to need software. CoinLedger. CoinLedger is the #1 software out there for individuals to plug in all their different wallets and get the reports on all of your gains and income for last year. And they do the DeFi wallets. They don't just do the big exchanges. #3, you take any crypto of any type of token and you exchange it for services or buy something with it. Oh, you bought an NFT, taxable. Oh, I went and got some money out of an ATM, taxable. I used to go to a restaurant in San Diego, taxable. If you use your crypto to buy something, that's equivalent to selling it. So if you go back to USD, you trade for another type of token or coin, or you use it to buy an NFT or a service or product, you pay tax. I'm sorry. I know this is not fun hearing, but that's water under the bridge for 2023. And I can't save you taxes for 2023. It's over. It's over. Whatever you bought and sold in 23 is over. And if you just bought it in 23 and just sold it now, it's over. You have to call your tax advisor before you sell. If you just say you own a rental property and you want to sell it. If you go to closing and sell your rental property and then show up at your accountant's desk and go, hey, how do I save taxes? They're like, well, before you sell it, let's look at a 1031. Let's look at a charitable trust. Let's look at an opportunity zone. Let's look at an installment sale. Let's look at a DST. What? You already sold it? Well, what the hell can I do? You already sold it. Now, we might be able to salvage a little opportunity zone if you want to go buy some real estate. Now I've got to figure out how to offset your gain with other investments. We have got so many awesome freaking strategies. We'd love you to do your crypto transactions in a Roth IRA and never pay tax again. The charitable remainder trust would allow you to sell all your crypto tax-free and create a stream of income. We've set up hundreds of charitable remainder trusts for crypto traders. Have a consult with a real tax lawyer on Main Street that's affordable. Our tax lawyers are super affordable. You can meet with them anywhere in the world on Zoom. We'll have a strategy session and see what you need. But remember, this is part of your bigger equation. What are you doing with this money? Are you buying real estate? Do you own your home? Do you have a revocable trust? Do you have an S corporation? What's your day job? What's your side hustle? People, this is what a tax advisor should be doing for you anyway. Now, I have a certified tax advisor network. And any of you that are enrolled agents, CPAs, accountants, tax lawyers, financial advisors, and you want training on how to be a certified tax advisor and provide advisor services, I have a 12-module training program. One entire module is on crypto, NFTs, metaverse, staking, mining, trading, capital gains. All of that is in a section. So if any of you are looking for a certified advisor in my program, you go to markjkohler.com and you can find one right now that's taking clients. And by the way, I don't make any money. I just give the network away. I want people to find, I'm a matchmaking service and I don't take any money from it. I'm taxmatch.com. I want great tax preparers hooked up with tax filers. Let's get you some help. For any of you that are looking to become an advisor, one of 12 modules is just crypto. Whole module on real estate, whole module on asset protection, 4 modules on tax planning, entities, the whole 9 yards. Check it out at markjkohler.com. All right. Now, let me just hit a couple other points, and then I'll take your questions. It's a big topic. Our Crypto Tax Summit is a full day at the Crypto Tax Summit. So what I'm going to show you here is what I call the trifecta. The trifecta is where we organize your transactions. If you're doing mining or any type of staking that is not custodial staking, so staking, mining, or I'm going to put some meta ventures. You're going to want to run that through an S corporation because that's ordinary income. That's how it works. If you don't, your taxes are going to be close to 45 to 50% on the first 100 to 150 grand. That's your tax rate if you're mining, staking, or doing meta ventures. Now, if you're holding crypto, all right, now I'm doing custodial staking, I'm buy and hold, I'm trading. That goes on the right side. Now, we might use an LLC for asset protection, or we just hold it in our revocable living trust. This all comes down to your 1040 and nets together. So people, if you're holding crypto, we're going to be over on this side. And this is where I'm going to put your NFTs, all of your coins, tokens. All right. So we've got to decide, are you doing operations with crypto or are you doing holding with crypto? And a lot of traders are doing both. I'm doing crypto mining and I'm going to pay higher tax rates on that. But as soon as I get my Bitcoin from my mining, it comes over here into a bucket. So you want to make sure you understand those differences. Now, the last thing I want to point out is NFTs are a whole other animal. And anybody that's doing crypto gets into NFTs pretty quickly. It's really the future of so much of our technology in this country. The blockchain technology is off the chart, NFTs. There's two types of NFTs. There's collectibles, and then there's utility NFTs. If you buy and sell a collectible, you have to pay the tax rate on collectibles is 28%. It's not pretty. If you buy and sell a utility token or NFT, then you can either get short-term capital gain or long-term capital gain, which is going to be a lower rate based on your bracket, and long-term capital gain could be 0 to 15 to 20%. In all these situations, you also have state tax. And if you go, well, Mark, I have my you take that. I have my server in Nevada, or I set up an LLC in Tennessee, or one of my 9 tax-free states, Washington or Florida or Texas. So I don't pay state tax because that's where my LLC is or my corporation. Whoa, whoa, whoa. You live in California. You live in New York. You live in Illinois. You're going to pay tax in California. There's no way around it. You can't set up a Nevada LLC and think you're going to get around it. You won't. California is all over this, and they have been for years. So it takes some planning. I am sorry to be the bearer of bad news. So get informed, get educated, because you're going to be more educated than your tax advisor with training at our summit. And any of you tax advisors out there, we got to know this. Now, I love CoinLedger. I'll say that again. CoinLedger is a good resource to start getting the data for 2023. File an extension, 4868. Get on my network and find an accountant, an advisor that can walk you through this when it's time to do your taxes.
All right, family. Hopefully I'm coming in loud and clear. This is morning trustee training. The time is approximately 8:41 a.m. Eastern Standard Time. You're locked in with your host, Bezel Bay. And if you listen long enough, hopefully you're learning something. Now, let me hip everybody to the fact that those of you that are banking in the box practitioners, we have already provided you a methodology and a mechanism to make sure that all of your quote unquote virtual currency transactions are in the right position. So I'm going to now go back to what I've said many moons ago, about 3 years ago, about cryptocurrency. I want you to understand that it's jurisdiction. So if you're practicing banking and you have a banking in the box platform that is in a jurisdiction that allows you to monitor private exchanges, then you totally avoid a lot of the things that was just expressed. But I'm going to say, for laughs and giggles, most folks who are listening to this particular podcast are not a banking in the box client. They're not CECL compliant, they're not DICE compliant, and they have not been reporting through currency transaction reports or on 8300 tax forms their transactions. So if you fall into the lighter of the two, you need to reach out to those fiduciaries that have the fintech to monitor the accounting and the non-interested third-party depository trust principles to make sure that you stay in the private exchange space. All this is done through fintech. The very reason why we as a collective family office introduced banking in the box was because of the fact that a lot of individuals were not going to get out of the SWIFT system until they were forced out. And because it's just like being somewhere and you're being evicted. If you didn't go ahead and become proactive, but you just let the eviction come and you're just kind of just waiting to see what happened, a lot of folks end up with no place to go, no place to stay, etc. Well, let's just call it what it is. When the pandemic came in, that was the eviction, and everyone who wasn't proactive didn't have a place to go. And so all of this spin, the age of spin, free money, free money, free money, and nothing in life is free. I kept telling individuals, especially when we was launching banking in the box, that I'm not going to tell you to get a PPP. I'm not going to tell you not to get one. Here's what I hear. Mr. Bay, I'm going to get a PPP loan and do this, that, and the other. I'm like, whoa. Isn't PPP payroll protection? You know, you got to already have payroll before you're able to take advantage of this system. So you're going to bend the rule and supposedly and allegedly use the funds to start a business. I don't think the program was designed that way. But who am I? Knock yourself out. Mr. Bay, I got my PPP and it's been forgiven. I'm like, well, if that's true, then where's the 1099-C for the cancellation of debt? I don't have one. So the reason why a lot of people have been evicted out of their place of comfort is because they didn't do accounting. We introduced banking in the box to be that all-in-one stop shop proponent, but there's a lot of moving pieces. And so for 2024, some of my practitioners who actually have the banking product, they are actively working their own banking platforms, have special incentives to get clients into that banking arena. So if you're loving what you hear, then stay tuned. We got more exclusive content coming down the pipeline. Yes, this will be syntax trust training, ethical hacking, and also the banking in the box class part 2 for those that are engaged into our platform. Hopefully you've learned something. Remember, if you listen long enough, you definitely will. And with that, we're going to say peace and love, family. Peace and love.